Good morning, everybody, and welcome. My name's Toby Potter, and I know many of you, and what a pleasure it is for me to see you here in person today at the first of what we hope is the resumption of the IMAP events series. What a year it's been for all of us. And this is pretty much exactly 12 months since our last live event, and we've all lived through a terrible period of uncertainty, both as individuals and as professionals. So here's hoping that this marks the start of the return to normality, and that represents the theme for today's conference, portfolio management in the new normal. Before I introduce our MC for the day, let me tell you very briefly about a couple of the things that we'll be doing through 2021. One of the lessons we learned from COVID is that the combination of live and virtual really works. And so one of the things which we've done is taken the webinar series which we ran in 2020 and adopted that as our new normal process for virtual events. It gives us an opportunity to take a single subject that's of value and importance to the advice community and drill down into it in a bit more depth. And so I've listed the first couple of those that we have scheduled for the first half of this year, tools that we use for portfolio management. So this is an opportunity to take a deep dive view with a number of practitioners on the technology that they're using to develop their managed account capabilities in March. And then in April, what I think will be a fantastic session, which is building a client base of wholesale and not-for-profit clients. So Greg Miller from the Executive General Manager of MLC Advice will be moderating a webinar series of 3 sessions made up completely of practitioners who've successfully built wholesale and not-for-profit based businesses. Or integrated that into their retail business. And then the final session in that series will be on the strategy of building an advice business with that focus. So John Woodley from Fitzpatrick's and John Barton from MGD, both of whom have made a success of that, will talk about the strategic drivers and what's necessary strategically to make a success of that. Later in the year, we'll be running our Advisor Roadshow, focused on the business of advice, particularly with a managed account focus in May. So it's now my pleasure to introduce to you our MC for the day. Al Logan will be known to many of you as formerly General Manager of Godfrey Pembroke Limited. Now a consultant with Marcona Partners, working closely with a number of leading advice practices. So please join with me in welcoming Al Logan, our MC for the day.
Thanks very much, Toby. Good morning, ladies and gentlemen, and good morning to the folks that are streaming. We're streaming and we're live. It's very exciting. I asked Toby what my role was as an MC, and he said, well, really, you've just got to keep people to time. Unfortunately, Toby's already buggered that up, and we're running late, so I'll do my best to get back on track. It's an absolute pleasure to be here, and thank you very much to Toby and the IMAP team for asking me. It's the first flight I took in 11 months yesterday from Melbourne. An interesting process, lots of maths, very good, rigorous introduction to the state of New South Wales. And it got me reflecting on this sort of new normal, the theme of our conference, and you hear about that a lot, COVID normal. And, you could be forgiven for sort of reflecting on the last 12 months. You could go either glass is half empty or glass is half full, couldn't you? And we all know about the half empty piece, the lockdown, etc. But there's been a few things, I think, from an experience perspective that really is cause for opportunity looking forward. Now, the first one is we've all worked out how to use Zoom. We've realised that actually we can do it. Even Toby can use it, surprisingly, when he's not on mute. And you know, we've rediscovered some time. I saw Andrew Tracy this morning, and you know, Andrew can see the office from where he lives and works, home, but he hasn't been there for a while. But it actually hasn't made any difference. We've still been able to connect with clients. We've still been able to do business. And I think that's a real positive that's come out of COVID. It's really accelerated that, no doubt. Just another you know, aspect that caused me to reflect on what humans are capable of. When you think that we're just vaccinating folks 13 months after COVID first hit Australia, and now we're rolling out the vaccinations this week, that's real cause for celebration. That's real positive. And then you add something that's really cool if you're a bit of a technical geek. I'm not, but I do like space. Anyone see Perseverance land on Mars last week? They put a rover on Mars. It's the size of a car. And they've dropped this thing down on Mars. It's got a drone in it. And this drone's going to fly around Mars and take photos. They're going to drill down. They're going to hopefully find some life. That's pretty impressive. So let's focus on the stuff that humans are capable of and the good things about what we can do. And I think let's leave the bad stuff in the past. So there's lots to talk about today. And we're using technology as well. So first thing is, if you want to access any event material, there's the QR code, scan it. It's right there. The biographies and all the material that's presented is available through scanning. As I said, we're streaming live, and so I just ask all the presenters to speak into the microphone so that folks at home around the country on their computers. Now, Dale Holmes is somewhere there at Manly, probably with his shirt off, but he's watching. Please speak into the microphone and make sure you're understood. Now, for those who are actually streaming, if you've got any questions, just type in your question. There's a Q&A section down the bottom, and then we'll make sure we read out your questions to presenters as we go. And we really want to make sure over the course of today that we have a lot of audience interaction. It's probably the first time many of you have been in a room like this for a while. So let's get the energy up, let's get some questions happening. There'll be roving microphones, and we'll make sure that if you've got a question, we'll get a microphone to you, we can capture what your question is. So let's have a chat about the first speaker and introduce the first speaker, Sharmath De Silva of Beta Shares. And his topic is the key questions to ask your fixed income manager. And there's a few to ask. Now, Sharmath has worked at Beta Shares for nearly 5 years. He previously held a number of roles at the Reserve Bank of Australia over a 7-year period, including as Senior Analyst, International Financial Markets, Senior Dealer Investments, European Representative Office, and Portfolio Analyst, International Reserves. He holds a Bachelor of Commerce Honours from the University of Melbourne and is a Chartered Financial Analyst. And in preparation for his session, he really wanted to say there are 3 areas that he's going to focus on. There's 3 questions that he's going to pose some answers to. One is, if you're an advisor and you're having conversations with your clients, what are you trying to achieve from a fixed income perspective? Secondly, what are the questions you should ask your manager in this space? And the third area of focus is really, how do you know you're achieving what you set out to achieve? So please welcome Sharmath De Silva to the stage. Hey, Sharmath. How are you?
Okay. All right. Thanks, Al. Thanks, Toby. Thanks, everyone, for coming. It's good to be back at IMAP in person. So I'll just start with just an overview. So I'll start off with just talking about the role of fixed income in defensive portfolios and how we see it. I'll cover some of the pitfalls with existing active and passive strategies. I'll briefly touch on product solutions, and I'll finish with what we think the key questions are to ask your fixed income manager. So at Beta Shares, we feel that fixed income should not be a one-size-fits-all solution. It should be bespoke. And really, it should be there to serve the overall portfolio. We don't believe in looking at a portfolio in a siloed way, but looking at it holistically. And I think one key consideration is, what are you trying to achieve? And one of the questions you should ask yourself is, what am I already holding in my portfolio? How much equities am I holding? What kind of equities am I holding? And once you have a good grasp of that question, then you'll have a better idea on what type of fixed income building blocks to use. I might just emphasise some of the benefits of fixed income and that they've provided, over the long run. So this is a table showing the excess returns that US Treasuries and US investment-grade corporate bonds have offered over cash over the last 50 years, covering a number of interest rate cycles and inflation regimes. So the key point I want to emphasise is that even within high-grade fixed income, you still do get paid for bearing interest rate risk and credit spread risk over the long run. And at the end of the day, they do provide a liquid defensive sleeve for your portfolios that should provide excess returns over cash. Now, cash rates are effectively at zero. However, bond yields are now significantly higher. We have seen quite a marked move in bond yields in recent months. Right now, the Aussie 10-year government yield is at around 1.6%. So it does mean that bonds can still provide excess returns over cash through a combination of carry, roll down, and even capital gains in the right economic environment. And we do feel that they can still diversify equity risk, especially if, let's say, the current reflation environment that we're in, rolls over. But perhaps the most important role of high-grade bonds in portfolios is that they provide liquidity in size to take advantage of, rebalancing opportunities, as well as to take advantage of dislocations or other opportunities in risk assets. Because, for example, if you're running a balanced portfolio, ultimately your equities or your risk assets should be the main driver of returns in the long run, and you want your defensive sleeve to put you in a position to take advantage and opportunistically accumulate risk assets where possible. So I might just start with some of the pitfalls of the traditional approach to passive investing in fixed income. The traditional approach is to allocate to liability-weighted indices, and probably the biggest flaw with such an approach is those indices, issuers can set their own weight, meaning that the issuers determine the risk profile of the exposure, not the investor. This is a graphic of the composition of the Bloomberg Osborne composite over the past 15 years. And I'll just draw your attention to the dark grey line, which is the modified duration of the exposure. And as you can see, that the duration of the Australian investment grade universe has increased from around 3 years in 2009 to around 6 years today. So the level of interest rate risk has effectively doubled over the past 11 years. And that's really been because of the lengthening in the average issuance profile. But I'll also turn your attention to the grey shaded area, which is the share of Commonwealth government securities, and that's grown significantly. So what I will just say is that, even if this exposure is suitable for your portfolio now, it may not be in a few years' time, just due to duration creep and segment drift. That's a natural consequence of changes in issuance patterns. Now, how about active management? So there are some terrific active managers in this country, but in aggregate, they have tended to underperform the benchmark. The chart shown is from the S&P's SPIVA report, and the orange and blue lines show the relative performance of the active cohort against the Standard & Poor's Australian benchmark. Now, active management in aggregate has delivered long-term underperformance, with underperformance most acute during periods of equity market stress, such as during the GFC and in March of last year. Now, one of the potential reasons is active management, in general, has tended to be structurally overweight credit. And credit is, an exposure that investors can easily get themselves now through index funds or ETFs. The chart here is comparing the returns on an overweight duration position. So that's the blue line. That's showing the excess returns of long-term treasuries over intermediate-term treasuries, and the excess return on credit, which is the orange line, and that's the excess return of intermediate investment-grade corporate bonds against intermediate treasuries. And what you can see about that orange line, that is the excess return on credit, it's a negatively skewed return series, with the largest drawdowns coinciding with periods of elevated equity market risk. And I've got the VIX and the S&P 500 on the lower panel. But the other issue that a lot of active, and just credit in general, has been liquidity. And generally you pick up a higher credit spread and you trade down liquidity for that. However, in a defensive allocation, we want to be able to take advantages of dislocations in risk assets. So I think March of 2020 was a good case in point. This chart is showing how many units of the S&P 500 various US defensive exposures would have bought you relative to December 19. And by the end of that quarter, long-term US Treasury still bought you more units of the S&P 500 than gold, corporate bonds, or US Treasury bills. And also, if you look at the that lower series, that's US private debt. You know, we have seen a big push towards alternatives, but I will just emphasize that alternative credit, like private debt, is not a one-for-one substitution for high-grade government bonds. So assuming you have a good grasp of what's in your portfolio, what type of equities you're holding, the nature of those equities, you're in a good place to customize and create your bespoke fixed income solution. And in the Australian market, there exists all the ETF building blocks that you can create this bespoke solution. So you're no longer limited to selecting a broad composite index. You can now separate government from corporate bonds, from duration from credit, and you can get the granularity down to even specific maturities on the curve. So one simple framework for diversification. This is subjective, but this is effectively, not a bad way of thinking about it. If you've got a longer time horizon, then your portfolio has more capacity to take on duration. If you've got more liquidity needs, maybe prioritize government bonds and cash over corporate bonds. If you've got a larger allocation to equities, your portfolio will probably benefit from more government over credit, although the benefits do vary depending on the nature of that equity exposure. If you've got more financials, more cyclicals, more value, you'll probably benefit from more duration, more government bonds. If you've got more, let's say, quality or more growth, such as US tech mega caps, remember there's a fair bit of embedded duration in those equity exposures, so you may benefit from, say, more credit and a shorter duration fixed income exposure. So even at low yields, fixed income can still add value and can still produce equity-like returns in the right environment. Just remember, the 10-year yield is 160 basis points. It was trading as low as, it was in the 50s, only less than 12 months ago. The 30-year yield is at 2.5%. In the right economic environment, you can still have the potential for meaningful capital gains to diversify equity risk. However, we should be mindful of the amount of interest rate risk embedded in our equity portfolios, because that can undermine the diversification that fixed income can provide. But I'll also say we should also be aware of the amount of equity risk or equity-like risk embedded in our fixed income portfolios, and we should be careful about the amount of credit and liquidity risk we're taking on. And I'll just be very cautious about, let's say, taking on excessive credit well into an economic expansion, especially when credit spreads are already tight. Because when credit spreads are very tight, the return skew becomes more left-tail dominant. So finally, there are a few questions here, but I'm going to focus on 3 important questions to ask your fixed income manager. 1, are your objectives aligned with my needs or my client's needs? 2, Are the excess returns you provided heavily correlated with equities? And 3, probably the most important of all, what am I getting for my management fee? According to Morningstar, the median active management fee in Australia is between 50 and 60 basis points. 50 and 60 basis points is a difference in yield between AAA rated 5-year bonds and single A rated bonds. 50 to 60 basis points is also the average credit spread in the Australian investment grade corporate bond universe. Fees matter, especially in a low yield environment. And when yields are low and credit spreads are tight, high fees could mean you're paying away a large proportion of the yield and the risk premium. So you need to ask yourself what you're getting for your fees. Are you just getting embedded equity beta, which you can get yourself at a much cheaper cost? And are you trading down liquidity? Now, just before I move on to questions, I'll just let you know that we've provided a questionnaire for you to fill out and send to your fixed income manager. And I'll also finish up with, at BetaShares, we cover every asset class. We're not wedded to any particular exposure, but what we do try and really understand is their interaction between asset classes, between sectors, between style factors. And if you ever need any assistance with any portfolio analytics, feel free to reach out. Happy to take any questions.
Cham, I've got a question, which is the way in which advisors might use the various vehicles to deal with the risk of interest rates trying to deal with inflation.
Yeah, I think it's a great question. I think that's probably what a lot of people are concerned about right now. I will say this though, if you are a multi-asset allocator, you're not limited to expressing your inflation protection or your inflation views within fixed income only. You have the ability to express that view through your risk assets. You have the ability to buy cyclical equities, to buy financials, to buy commodities. And I'd argue that provides much better inflation protection or inflation upside than trying to tilt within fixed income. Because at the end of the day, credit spreads are tight, inflation-linked bonds are very expensive, so the amount of upside you get from trying to do that inflation play within fixed income is pretty minimal. So my view is, you're probably better off expressing that view from risk assets or expressing that concern via tilts in risk assets.
Other questions for Cham on fixed interest asset class?
Great.
Oh, hold on, there's a question over there. I saw a hand go up. There it is.
Sorry, I just need to speak into the mic. Thank you. Angela Ashton from Evergreen. I just had a question about one of your first slides where you talked about returns over the past 50 years.
Yeah.
I think if I were to be critical, I would say that 40 of those years were pretty similar, i.e. they were a disinflationary environment, and really the only decade here that's actually different is the 70s. And we can clearly see that was not a great decade for bonds. So please explain.
Yeah, and I'll say that was not a great decade for financial assets in general. It wasn't a great decade for government bonds, it wasn't a great decade for corporate bonds, and it wasn't a great decade for equities. I mean, this was a period of high inflation, but it was also a period where real interest rates were forced very high by the end of the 70s by Paul Volcker. So, obviously, if you do think that we're going to get into double-digit inflation, if you do think that central banks will be hiking cash rates to as high as the high teens or even, 20%, as happened in the US, then it's not going to be a great decade for fixed income. That's not my view at the moment. But ultimately, over the long run, and if you've got a horizon, a very long strategic asset allocation horizon, it's worth thinking about the diversification benefits that fixed income provides. And if you are worried about inflation, long-term bonds will probably underperform, but there are many other asset classes that will do very well in that environment.
Thanks very much, Cham. I think that's always a tough gig for a speaker off, and I think you did a great job. For me, I think the last question you posed to the room about what are you getting for your fees, I mean, it applies across the board, but I think it's particularly critical for us as we go forward to reflect on that, because if we don't think our clients will be asking us that question, we're probably not in the real world. So we'll move on to our next session, which is a panel session, and it's called The Challenges of Building Managed Account Programs for Larger Advice Businesses. And it'll be moderated by Angela Ashton, who I know is here because she asked a question. Thank you, Angela, from Evergreen Consultants. Many of you will know Angela. She co-founded Evergreen Consultants, a bespoke investment consultancy firm assisting financial advisory firms to really look at their investment processes. She's held senior roles at QIC, at Lonsec, and she was head of ratings at Van Eyck, so a very experienced person. Angela, please welcome to the stage, and I'll let you introduce the panel. Thank you.
Thanks, Al. And thanks, everyone, for joining us today. I guess this is the first panel that many of you have been to for a good year. And like, no pressure on us, of course, to deliver something great in that case. Hi. Luckily for me, I'm just the moderator, and the true talent lies next to me here. I'll start by introducing our three speakers today, and I'll ask a few questions. There should be heaps of time for Q&A at the end, and please feel free to put up your hand when the time comes. So, sorry. At the end, we have Justin Mclaughlin. Justin says he has 20 years' experience, but I've known him for more than 20. So that might be a bit of a white lie. He has 20 years' experience in the industry. He started his career at what is now CSS PSS, and he has held the roles of Chief Economist and Investment Strategy at Advance Asset Management and United Funds. He was also at Bridges for quite a long time. To my right is Martin Crabb of Shaw and Partners. Many of you will know Martin, certainly one of our more, verbose people in the industry.
I think that's a compliment.
Yeah, it is a compliment. Martin joined Shaw and Partners in April 2011, and previously he was at Macquarie for over 20 years, where he was an executive director in areas such as institutional stockbroking and wealth management. Excuse me. And in the middle we have Paul Saliba from AMP. Paul has management responsibility for direct share portfolios for the AMP-aligned licensees and managing listed securities and contributing to the team's model portfolios. Paul's had a long career in the industry with roles at ANZ, Citigroup, Credit Suisse, Lachlan Partners and IOOF. So to begin, my first question to the panellists are, and I'll start with you, Martin, what do you think are the most important considerations in building model portfolios that will suit a broad array of advisors?
Yeah, it's obviously a good place to start, isn't it? So we're lucky enough, I suppose, at Shaw and Partners that we got to start with a blank sheet of paper a few years ago. We didn't really have a managed account program 4 or 5 years ago, but we had a VRAP program, so we had the premium VRAP platform there, and we had a large chess sponsorship, so we had a lot of assets. We just didn't have the program, so I suppose we got to build it from scratch. And I think if you do that, you probably approach it a little bit differently than if you're taking over a legacy business. Like a lot of managed account platforms are probably legacy ones that used to be wrap platforms, and they've converted them. So we took the view, and I'm sure the other guys will talk about this as well, of this concept of building blocks. So rather than giving people preset portfolios that are balanced growth or conservative or whatever, is to actually give them the underlying sleeves, the underlying portfolios that sit beneath that. So we've found, and I'll give you some numbers for sure, we've got about 1.2 billion in our managed account program. About 800 mil of that is from internal advisors, and only about 10% of that is in the preset portfolios. So advisors are choosing to use managed accounts to complement what they're already doing, or maybe to access an asset class that's difficult to access by themselves, so alternatives or global equities and these sorts of things. So I think the most important thing, if you are building one or thinking of building one, is to definitely take that building block approach, and it just allows your advisors a lot more flexibility.
Okay, thanks, Martin. Justin, do you have any thoughts to add?
Thanks very much, Angela. So I agree with the building block philosophy. We did it slightly differently, and I guess you can build building blocks vertically or horizontally. And what we did with building blocks is we took the view that we did want multi-asset class portfolios in the sort of the classic balanced growth and income style buckets, but what we wanted was a series of them. And then I guess the question then is, again, going to first principles, what problems are you trying to solve? And from our perspective, I think we came up with the idea that, you know, what do planners typically like? What are the three variables? And there's typically a cost variable, and you know that sort of relates to the income, sort of the index versus active. So we have index models as part of our suite. Then in the active suite, there's the question of how much discretion do you give managers? You know, what's in them, ETFs, managed accounts, whatever. And again, we've tried to have a couple of different suites there. And what we find is people tend to blend growth models or balanced models together, and sometimes use a core satellite approach. So I don't think it's conceptually different from what Martin was saying. It's just a different way of putting together building blocks, that's all.
Paul?
Yeah, I think one of the interesting things is when you're building managed account portfolios for large groups, is that, you know, at practice level you'll have differences of opinion about investment philosophy and so forth. And so at AMP what we've done is we've developed risk profile based portfolios. We've built them for accumulators, we've built them for retirees, but we've also built core and satellite to allow for those who want more a passive approach. And then we're looking to launch potentially listed solutions where everything involved would be listed. And so I suppose that allows for advisors to express their own philosophy, or indeed dial into the philosophy of the end client and select a solution that meets the needs of the client but is also philosophically consistent with their own views and opinions.
So, Paul, that would mean you'd have 30 model portfolios?
So we've got a set of 5 accumulation models, a set of 5 income-orientated retirement portfolios. We've got 2 specific retirement portfolios, and then a set of, I think, 5 core and satellite portfolios. And that is one of the challenges, the proliferation of models. I know that previously at IWF we had something like 62 different portfolios, and then it becomes a challenge in managing that.
Yeah. Justin, how many models does Clearview have?
I think at the moment we're probably around 23, 24.
Right, and are some of those from past groups that you've taken over?
No, and the nice thing about models is implemented models in whatever legal format they are, you can actually change them quite easily. So legacy isn't quite as big a problem in our experience as with others. So no, these are all, if they weren't new to start with, they've been upgraded over time.
Yeah, okay. And Martin, how many do you guys have?
12.
Okay. So there's quite a lot of administration, I guess, and compliance and so forth that's associated with managing models for large groups like this.
Yeah, well, I think, and it comes back to how active your asset allocation is. I mean, last year was a classic example. If you just sat on a 70-30 portfolio or a 60-40 portfolio, by the bottom of March, you're probably a 50-50 or worse. And so, you know, you have to be constantly rebalancing those portfolios back to their model. So people who didn't do that last year, obviously missed out on some great buying opportunities when the market bottomed out. So I think just having the models there is one thing. We've had quite a few advisors join from other firms and just talked about their experience last year where, you know, maybe the portfolio moved by 1% in March. It's like, hang on, it should have probably moved by 15 in terms of the asset allocation shift. So I think the more models you have, the more work, as you said, you've got to have. You get a whole team of people kind of rebalancing them all the time.
Yeah. So if we add on then, say, multiple platforms, how does that then, affect what you're offering?
Yeah, we're only on one platform, so it's pretty easy for us. But going forward, we intend to be on more platforms, and so that'll just be more work. So, and again, it comes back to, is managed accounts your business? Because for us it is, our investment team internally, all we do is manage accounts. For some managers, they're managing unit trusts or maybe institutional mandates, and the managed account can be a little bit of an afterthought. So if you're a fund manager and you're on 8, 9, 10 different managed account platforms, you need to ensure as much as possible that the end client gets the same outcome regardless of where they are. So the same goes for guys like us. So we've got to make sure that no matter what platform our clients are accessing it on, they're getting the same result, the same outcome.
Yeah. Paul, how many different platforms does AMP use, and how do you manage that?
So we primarily use AMP platforms. We've got our managed accounts on MyNorth and North, but we are looking now, exploring other avenues. What we've done is we've opened, advisors' best interest duty allows them to ask for one-off approvals for other platforms, and we get a range of platforms that advisors use outside of the APL. And so now what we're looking at where the money has landed and exploring where we could land our existing models or portfolios in third-party platforms.
And Justin, what's Clearview's approach been?
We're on a couple of platforms, and our experience has been, I think, the more you get on, the harder it gets to some degree. I think there's this wonderful idea of just scaling your product across all platforms, and I think that's a little bit harder than it looks. You've got different trustees with different, rules around asset allocation, and then you've really got to sort of justify volume to justify the cost of establishing it. So I think it's an interesting question as to how prolific these models are going to be across platforms. At the moment, we're only on a couple.
Okay, great. In terms of, I guess, your responsibilities within the managed accounts themselves, where does it start and stop for you? So do you consider asset allocation, manager selection, stock picking, product management? How far do you go in I guess, the value chain of management?
Yeah, we do everything. So from strategic asset allocation, because you should be, reviewing that relatively regularly, not every day, obviously, but are the assumptions that you're using in your capital market analysis and so forth, are they being reviewed? Obviously, there's a big thing now about inflation and real rates and that sort of stuff. So I think strategic asset allocation, and then obviously you've got your investment committee and any tactical asset allocation. So some groups are very formal on that. They have a very sort of quantitative approach. Other groups are more sort of anecdotal and ad hoc, and how they're seeing valuations, etc. And then you've got your manager selection and or security selection. So we think in some asset classes it makes sense to use managers, and I think small caps is probably one, just to get the pre-IPO stuff, to get the IPO activity, to get the spread of securities, to deal in illiquid securities. It's really, really hard to do that in a managed account. In fact, we tried when we launched and we just found it too hard. So I think some asset classes, Angela, I think it makes good sense to use managers. In others, like large cap equities, hybrids, etc., we prefer direct security. So I think you've probably got to be set up to do all of that. Now, a lot of people will use consultants for probably the first 2 or maybe even 3 steps of that, and then obviously have a team that does the security selection, either internal or via manager. But I think it's important to get involved in as much of it as you can.
Paul?
Yeah, so we do end to end. We don't do the implementation of trades. We also launched more recently ESG and ethical portfolios, where we've outsourced the investment building of the portfolio, the construction. So we put to the manager a universe that they can select from, and obviously in ethical and ESG, it's
securities, you mean?
No, in terms of funds.
Okay.
And so we put forward, given that space, a fairly limited universe of managed investments that they can use, and then they blend it according to the risk profiles that we have within the AMP licensee. So we're doing investment selection, we're doing portfolio construction, SAA, and any tactical or dynamic allocations. We're not generally a dynamic allocator, the implementation is then put through the platform, and so we just really focus on the research, the investment, and the portfolio building.
And Justin?
So we principally do the asset allocation manager selection. We do actually have an RE capability, and we do issue mandates, so we can do funds. What we found is if you're doing a fund in the context of a managed account, you really have to, I think, generally speaking, do a single manager fund, and you want that manager's name prominent, because otherwise you're kind of really going back into the fund-to-fund world, which is a perfectly great world, but it's not the managed account world. So we do that as well. We don't do individual stock selection, and we outsource that basically in terms of if we were to use direct equities SMA, we'd appoint someone to do that for us.
Yeah. Okay. So liquidity is an interesting issue. How do you manage things like those illiquid asset classes? Even, in a fund you may have monthly liquidity and so on. How does that work in a managed account like this when you've got a lot of applications and redemptions coming out? Shall I start with you, Justin?
Well, we pretty simply avoid it to some degree. I think illiquidity on platform is hard anyway. Yep. You don't find too many platforms that give you much in the way of illiquid assets, and illiquid assets in a managed account context is even more challenging because you are essentially the portfolio manager, and you don't want your portfolio rebalancing or your asset allocation changes to be dictated by the illiquid assets. So there are ways around it. There are some asset classes where you have assets that are kind of illiquid and are in a sort of a listed investment company or a fund or an ETF context. But generally speaking, I think we avoid illiquid assets. We just don't think that's part of our universe.
Yeah. Paul?
Yeah, we face the same problem. Obviously, you're trying to do rebalances. You're not rebalancing to a particular time in the month when monthly liquid vehicles enable their fund to be traded. Of course, one of the problems of multi-platforms is a different menu on different platforms, so that can also be a challenge, which we don't face yet, but probably will when we go to launch in other platforms. But so we are using daily liquid managed funds in all of our investments. I think when it comes to listed securities, as we go down that path, then in the equity space we'd focus on, as Martin said, your larger cap stocks. We wouldn't do small cap and certainly not micro cap, and probably use managers in that space that are daily liquid solutions. So, my experience is that tends to be driven also by the platform. A lot of the platforms just don't enable monthly liquid or less liquid vehicles to be used within managed accounts.
It's a real challenge, Angela, because there's obviously an alpha out there for illiquidity, and it'd be great as a fund manager to try and access that alpha. But if you've got a platform that requires daily active trading, because they've got cash flows every day, right? So they need to trade every day. So I think there's obviously forces at work to try and close that gap. I mean, I think Partners have got they're obviously a fantastic private equity manager. So they've got a fund that's got some limited liquidity. I think it's got some listed securities in it that allows it to have some liquidity. And there are funds that gate, once a month or whatever. So I think the gap's closing, but I think it's a little bit the holy grail. Can we access the unlisted illiquid premium with by being liquid and tradable, and that I don't think that works. But certainly there's a lot of people who are looking to sort of close that gap at the moment.
Yeah, I think even monthly though does create problems, right? Yeah. So let's move back more to this to I guess what you guys specialise in terms of building and managing these sorts of models for a large group of advisors. What value is there in getting advisors involved in the process of building and managing these portfolios, and how do you do that?
Yeah, that's a good question. I mean, again, we're pretty lucky in that we designed something from scratch. So I've been working with advisors for a long time, and so I think I know how they think. Sometimes that's...
I think they all think differently.
Yeah, they probably do. They probably do. I'm a bloody individual. So I think it's important to stress test your portfolios with real people and real advisors that have to deal with clients, and obviously getting feedback from advisors is a challenge. So we've got we can throw our arms around our advisors, but guys like Paul's got hundreds of advisors So how does he get feedback? It's probably more a challenge for him. So I think either having a formal process of reaching out to advisors and saying, are you happy, or is there anything you want to change, or is there a new product? I mean, you can't do everything you get asked to do because you'll just be chasing your tail the whole time. But things like liquid alternatives. So everyone sort of wanted this 2 years ago, and the returns from liquid alternatives have been pretty average, right? They haven't. I think I heard the Future Fund on a conference the other day saying that their manager failed them. They use Ray Dalio, so they weren't happy with Ray Dalio at Bridgewater. Had failed them. So I think so if you're introducing a new asset class or something like that, it's really important to sort of check it with advisors. Are they using it? Do they understand it? Are clients getting the benefit from it? So I think that's a real challenge.
Okay. Paul?
Yeah, and you're right, Martin. It is difficult with 1,000 odd advisors. We have a working group with advisor representatives from each of the licensees, and we take it up a notch. So we don't get them involved with the managed accounts, but what we do get them involved with is things that we're manoeuvring through the APLs. And so we would articulate that we're bringing this on to the APL to suit a particular part of portfolios generally. And that opens the door when they say, yes, we'd like something like that, or no, our clients, generally, and it's a massive generalisation when you have a handful of people around the table representing 1,000 odd advisors. We get that feedback, and that gives us some confidence at the level for the APL, and then we're selecting from our own APL. So that makes it sort of engaged without being really involved with the actual managed account itself and causing issues around front running and that sort of thing. I mean, you just can't have people know what you're thinking you're going to invest in a managed account, because that's not appropriate. So we balance it through a working group and managing the APL rather than letting them get insight to the managed accounts as such.
Okay. Justin?
Yeah, it's an interesting question. I think our experience is, I think it mirrors the other two guys. You have to have engagement with planners on an ongoing basis, and the great thing about planners is they're not shy, and they'll step up and tell you exactly what they think at any point in time, positively and negatively, and that's great. One of the things I think with managed accounts you have to be a little bit careful of is, to some degree, managed accounts are suitable for financial planners, I think, who are saying, look, I delegate parts of my function and I concentrate on parts of my function. So I am and typically the person who uses a managed account will say, look, my fundamental focus is the expertise I bring in financial planning, and the investment management and mix I'm less concerned with. And I'm comfortable to outsource that to a trusted partner, whether that's the managed account provider or a fund manager or a fund to fund. And what you tend to find in our experience with dealerships is the people most interested in being on investment committees and on consulting groups are the least interested in delegation. So they're the people who actually love to do it themselves. So I can sort of give you an anecdote. At one point we had a working group that did this, and we were all doing our managed portfolios together, and I turned around and I said, okay, so you're all involved in the managed portfolios, we love your contributions. How many of you are using it? Not one. So the people who love that sort of activity tend to be the non-delegators. And so you really have to say, what am I building this for? Am I building this for the guys who love the investment side of things? And if you do, that's more a bespoke solution, I think. It's not a wide dealership thing. And you really kind of have to say, no, I'm building this for the wider group. And in that case, you certainly take counsel and listen to planners, but I think you do, as Paul said, you separate it out. You accept the fact that you're going to be the portfolio manager for that sort of particular product suite.
Okay, thank you. So thinking about, I guess, your ability to, get a lot of funds under management, how do you take advantage of any buying power you might have? Should we start with you, Paul? Given AMP's probably the winner in that respect.
Well, I'm not sure. And when I went into IWF, going back to previous work experience, we did deals with managers at Shadforth that, we had Chris, you all know Chris at IWF, says, we've got deals, talk to our people down in Melbourne. So I talked to the people down in Melbourne. I said to Matt Drennan, what do you know, our deals are just as good, if not better, than the IWF deals. And I had a sense that because we're a small business, that we wouldn't take up much of their FUM capacity, and therefore the discount they provided us was actually less impactful from their business perspective whilst securing another client. So I'm not convinced that they do. But at AMP, the research team who manages the portfolio doesn't deal in the commercials. We try and avoid all of that. NMMT, which is the trustee the RE, of the managed accounts, and they do this for our internal as well as third-party managed accounts. They work out solutions with managers and get discounted unit classes. Now, some platforms, of course, can have rebate systems, and when I was at IWF, I negotiated rebates with a lot of managers to put into managed accounts. And so that's another way of doing it. However, within the AMP world, they can't facilitate rebates. So we go to managers and ask, or they go to managers and get discounted unit classes, and then we use them as they become available. And we don't even switch as a matter of course, because the discount might not be worth the spread and the transition. So we'll use them when they are desirable and when the discount is worthwhile, particularly if we're actually making a change in any case. Do fund managers or have fund managers given you specific unit classes just for you? Again, we're not involved in it. My understanding is this is a method that they're looking at, so that might be something they're rolling out more broadly, but I don't actually know the answer to that. Martin, how do you...
Yeah, there are some managers that we use that I think one of the funds we use is a seed fund, so that was set up under its own APIR and it's got its own fee structure that's different to the headline fund. There's a couple of managers who have different funds for different platforms, so they might put a different structure together for Hub or something like that that's got some fee differences. So you absolutely have to use your bargaining power if you have any, and obviously the bigger you are, the more bargaining power you have. So just some anecdotal stuff. So if you talk to global fund managers who participate in managed account programs, they think that the 50 points they get in Australia is actually quite attractive. If you're on a big platform in the US, it's more like 20 bips for active equities. So I think that's probably what the big industry funds pay here. So that's kind of where fees are going for managers. So, there's still, some of them are still getting, more than 1% for wholesale long-only equities. And I think that gets down to 50 for a managed account. And if you go really, really big, it's more like 20. So if we can get that in a low return environment, if we can get some of that to our clients, that's going to make a material difference.
Justin?
So where we have our own funds and where the RE, we can do those sort of negotiations. I think this is an interesting area because talking to some platforms out there, there's an awful lot of rebates and everything else happening in the industry. And I think everyone's intention is good and everyone's trying to do the right thing by the client, but it's becoming an administrative nightmare. And I have real doubts about the sustainability of this and the viability of this as a solution. And I think in the longer run, we're probably going to end up with, I would hope, common asset classes. Maybe if you do your own fund, you can, if you're AMP, you can put X billion dollars in and get a special deal, which is great. So I would I think we're in a transitionary phase at the moment where we've got this messy system of rebates and everything else, and I don't think it's sustainable in the long run.
Yeah, I think I agree with you. In terms of, I guess, the models themselves, do you consider them a revenue generator? Are you just looking for cost recovery, or is it part of the deal as being a licensee?
Yeah, we just pass it through to the client. So any rebate or lower MER or whatever you negotiate, but basically that just...
I think the question is really more around the idea, do you charge a fee for management within the model itself, and why?
Yeah, we leave it to the advisors. So the way we do it is any internal provided funds or not funds, strategies don't have an embedded MER in them. So we just leave it to the advisor to charge an advice fee, which captures that management fee. So, because I think if you've got internally managed funds, you've got this whole conflict of interest issue that you just need to be very careful of. So an elegant way around that is to not charge an MER. So if you came, Angela, with your tens of millions of dollars to Shaw and Partners, and we put you in the large cap equity and hybrid portfolios, your advisor would just say, well, this is the fee, and that's all you would pay for those strategies.
Cool. I wouldn't let Aggie manage my money though.
Oh, he's pretty good.
Paul, what are your thoughts?
Yeah, we don't. I mean, the NMMT is the RE charges an RE fee. The investment management and our team, we're not a revenue part of the business, which makes some things challenging. But there is, I think, a notional cost recovery. But yeah, we don't. It's certainly not a generation of revenue for our part of the business at all.
Justin?
So we do run these as financial products. We run them as SMAs, and so we do generate revenue off them. I think it's an interesting time in the market insofar as, we're kind of at a juncture now when some of the functions that were previously done by internal research teams are increasingly can be substituted for by products, which are SMAs. And some of the internal research teams who are very good are actually finding that they can actually go out into the marketplace and sell their wares. And if they do that, then they'll have to treat this as a financial product. And I suspect that if we look in 5 years' time, what we'll find is that people running these managed accounts in various guises will actually be more product manufacturing oriented. Dealerships will have a range of models on their APLs, and some will be internal and some will be external. And so I think it's an interesting juncture to be involved in this sort of an area.
Yep. And finally, what does success look like? How do you know that the models that you've put up are successful?
Yeah, it's a good question. I mean, I think my perception is that you're just on a journey, right? So you're a journey and trying to provide the best outcome for your client. And I think we've still got a long way to go in terms of, doing tax management and portfolio optimization at a client level and minimising transaction costs and getting management fees down and all that sort of stuff. I think we're just continually on that journey. So, I mean, the obvious measures of success are the amount of money that you've raised and the performance that you've generated for your clients. But I think at a product level and maybe at a dealer group perspective is, what's the client outcome? Are we doing the absolute best job we can for the client in terms of best use of technology, lowest cost, best managers, best security selection, all that sort of stuff. So I think we should always be on a journey of self-improvement on that front, Angela.
Paul?
Yeah, I'd agree with that. I think success is clearly that they're broadly adopted, and so you're building solutions that get to the middle. If you think of a normal distribution of your client base, of your advisor base, that you get to the middle of that and you capture as much of it as you can. You make their lives easier, as in the financial planners, the advisors. You make their lives easier and their clients' lives easier. So that means you need to deliver solutions that are relevant, that deliver on the goals and objectives of the clients, and obviously have good, acceptable, market leading. We can't all be market leading. Risk return metrics. But key to it is delivering on the goals and objectives that clients have, and so getting FUM to deliver that.
And Justin?
So, I mean, obviously, I think I agree with both speakers. Those are, clearly the primary elements. I'll just add a secondary consideration, just for people's thought. Another way to think about success is to say that in the financial planning world, we've kind of moved from a world of subsidisation to a world of no subsidisation. And anyone who's in financial planning has no doubt noticed their advice fees have gone up a lot, and they've probably noticed that efficiency, which they didn't think about too much in the past, is coming really to the forefront of how they run their practices. And so I think one of the additional things, or one of the additional success factors that I would say that perhaps managed accounts can bring to the table for financial planners is really in how they operate their practices. And I think that's probably hasn't been thought about as much as it should be, but I think, to drive value into a practice, to get good outcomes from a practice to clients, I think we really have to change how we're doing things, and this is a good solution for that.
Thanks, Justin. That's the end of sort of my questions. So I'll open up to the audience if there's any questions, or if there's any online through the streaming, which I think come up here, right? Any questions from anyone in the audience?
I'll ask one if I can. I wanted to ask about the analytics that you might use, what systems you use now versus what you might have used in the past, pros and cons, prices, things like that.
Yeah, we love Excel. The whole world runs on Excel, right, doesn't it? Yeah. Look, there's some really good risk management software out there, but it's quite expensive. I mean, FactSet have got some fantastic portfolio analytics, as do Bloomberg. So a couple of guys in our
And
firm...
BlackRock, our fine sponsor.
BlackRock, yeah, they've got the best system in the world, BlackRock. Love BlackRock.
It's called Aladdin.
Aladdin, that's
Yes.
right. You just rub it and the genie comes out. That's great. Yeah, look, it's really the sophistication of software for managing portfolios has really improved, even at the execution level. I mean, Iris has got a really good system, and look, I'm sure there's lots of other vendors out there that have got some really good technology. So I suppose the improvements I've seen in the last probably 5 or 6 years is more on the risk analytics, is just looking at things like VAR and tracking error and these sorts of things, which a lot of systems really weren't designed to do. So I think that's really improved, and just to help portfolio managers make better decisions in terms of looking at the risks that they're taking on in portfolios. I think that's a real big area.
Actually, just before the other two go on, to that point, when we do the awards each year, we do actually use Aladdin as part of the licensee evaluation process. So we do actually put the licensee portfolios through Aladdin, and it actually yields really quite striking insights. A number of the judges are here today. And so there's an institutional tool being applied at, in some cases, literally a practice level.
That's a multifaceted plug there, Toby. Good on you.
Well done, Toby.
Plugged half the room. It's extraordinary.
Right.
Yeah, Excel, we use Morningstar Direct. On the equity side, which we haven't launched as SMAs as yet, I'm using FactSet, but I haven't subscribed to all the fancy risk tools because, as Martin alluded to, they are very expensive. So we're looking at how we would do that going forward. Yeah.
Justin?
So we also use Morningstar Direct. We have access to Bloomberg, so we can use that as well. I think, the interesting question in some senses from an analytics and reporting perspective is, what's useful for the manager and what's useful for clients. And there's a fine line, I think, between giving people, it's an interesting question of how much information do you give them and what do they value. What we've tended to find, if you run portfolios through an analytics package, whatever it happens to be, it's actually really simple stuff that clients want. They want to see their broad exposures. They want to see top 10 holdings. They're not terribly interested in a lot of the ratios and the Sortinos and the tracking error and all this sort of stuff. So I think you can use the analytics tool both externally and internally, and I think it's a valuable thing to offer externally. But be aware of, getting the reporting right for clients, because I think you can really lose them very quickly if you put too much out there in terms of technical, gibberish.
Yeah, Amanda, I'll answer that question too. So we've got our own analytics system in-house. We use FE for data, and we do try and get the odd, other system. But we have built a lot internally, and the last thing that we've built is stress testing and scenario testing, and we did that using a factor-based approach. So we can build back funds, that didn't exist in the GFC, effectively through the GFC, for example, and test how portfolios went through that period. So that might sound fairly easy. It took our program of 3 months, and I think it's really insightful and valuable. So, we're trying to improve on all of those things, and we show that obviously to our clients. Our clients can get that. Whether they choose to show that to their clients is up to them. But for us, and I hope our clients, it's valuable in showing them different ways to look at the portfolios, because we break up what each fund would have done through that period. So you can see the contributors and the detractors, and Dean's here, he'll talk to how good it is. So, we're trying to do that sort of work as well. But I think Justin's point is well made. You really have to think about who your audience is, whether it's just for you or whether it's actually for the end client.
Other questions for our 3 extremely experienced portfolio managers? Yeah.
Thanks. I just had a question regarding the optimal size. I mean, you're up there talking about developing managed accounts for larger firms, but I'm just interested, looking forward for the next 5 years, you know, how much funds under advice do you need, do you think, in a particular model portfolio as you go forward to make it viable and efficient?
So, I mean, I can start. It depends a little bit upon your business model and your margin, obviously. I think there is. I think the nice thing about managed accounts is there's a lot of external technology that exists within platforms and that you can build yourself, that you can actually run these things at a relatively low level of scale if you want to. But you're not going to really make much money out of them if you do that. You're really going to have to make your money out of other things that you do. I think if you go, if you look at it in a larger context, I think in a sense it's not that dissimilar a model from a fund to fund. Again, you charge a little bit differently, your margins are going to be a little bit different. And there I think it's probably certainly north of $1 billion, $2 billion. You have to get into that sort of range to support a team and everything else. So I think the real question there is, and I think it's not, there's not a right or wrong answer here, is, I mean, if you're a financial planning group and you earn your revenue from advice fees, this just might be a value-add service you provide, and you may not seek to make revenue out of it, or you may only seek to make revenue out of it externally, and that's fine. I mean, you can offer a very good quality service. I think if you're going to go more than that, you do need certain amounts of scale. So you have to get rate and all that sort of stuff as well.
Yeah, Justin, when you say that, you mean across the whole program, the whole managed accounts program, $1 billion, as opposed to each model, right?
Yeah, for the program as a whole.
Yeah. Paul, Martin, do you have any?
Yeah, it's interesting. I mean, I just looked at the AMP models yesterday by model, the FUM, and there's a couple of risk profiles or types of portfolios that are fairly unused, let's put it that way, you know, $1.5 million, whereas the others have, you know, $100 million all up. We're in the circa $1 billion, north of $1 billion if you include 100 plus million that I'm running for AMP Foundation. But if you exclude that and go for the advisors only, it's just under $1 billion. And we've done that in a couple of years. We only launched them going on 3 years now. And I think that's certainly, you know, a sizable scale. We're not charging fees within our department, so it doesn't really affect us. But I think in a large shop, if you're not getting, you know, significant flows, and if you're not, you know, generating flows, and you don't have a sizable chunk of money, then you're putting a lot of effort in reporting and the analytics and so forth, and going back to the RE each year with all the data that they require, and third-party ratings. It's a lot of effort if there's not much in there. So I don't know the number, but certainly, you know, as a large business, you need a large amount of FUM. Smaller businesses, you can do it on a whole lot less, and you'll probably have a much smaller team than what we have within AMP Research. And like what was said, you know, it is pretty scalable and doesn't need massive scale to be, you know, reasonably viable in the first instance.
Yeah, I'd concur with both Justin and Paul on that. I think $1 billion is probably the magic number for if you want to go it alone. You can probably make it profitable or break even at less than that. And the only one other point I'd add is obviously there are some strategies and some asset classes where there are diseconomies of scale. So, you know, small caps is an obvious one. There's a lot of managers out there, once they reach their 500 million or $1 billion, they sort of shut the place down, which makes their inclusion in a managed account program really problematic because you can't get the liquidity. So, you know, that aside, you know, as Paul said, bigger is better.
I'd like to come back to the question of best interest. Paul touched on it through the course of the discussion. So the question is really, you know, as an advice licensee, how do you address for your own advisors, you know, their best interest obligations and yours as a licensee, given that these are effectively in-house products?
Sure, I might have a crack at that first. We run our dealership as an open APL. It has about 12 platforms on the APL. It has X hundred managed accounts. It has X hundred direct equities. very hard to say that client best interest isn't served there, and we certainly have non-APL approvals which we never unreasonably withhold. I think we also have some other managed accounts on our APL, and so our APL, we have to compete with others. But it's actually an interesting question, isn't it? Because it goes to the heart of, are you going to offer something internally or something externally? And there isn't a right or wrong answer to this. I think you can have very high quality internal offers, and I think they're sometimes dismissed unreasonably, but they can be really good for planners and clients. But I think the way the industry is heading, we are moving more into an open architecture world. And I think increasingly, as I said earlier, you're going to find managed account providers in dealerships increasingly offering products outside dealerships. I think, and also you're going to find external parties offering them into your dealership. And the question is how many, and that probably goes to more what the dealership's philosophy is in terms of, you know, APL and number of providers and everything else. So I think we can kind of put our hand on our heart and say, you know, it's very hard to argue that any of our planners are constrained in any way.
One of the challenges is that managed accounts, you cannot go into Lonsec, Zenith, Morningstar, FE, SQM. You can't go into those systems and see monthly performance, get tracking error, get their volatility, their performance over different time frames, their performance during drawdowns, their drawdown analysis. You can't do any of that quantitative analysis on managed accounts because the data is not available. And that also makes it hard as a research team to go and select best of breed SMAs because it's very difficult to do that work. So we have our SMAs available on the APL. We do have a range of other SMAs that are primarily run by fund manager institutions that you can get some insight to their track record because they've got a like fund that runs that way. And then we have a range of SMAs on the platform run by various consultants who advisors can get one-off approval for. And so we leave it to the advisors to work out the best interest duty. Obviously the licensee is helping them facilitate that with the information that we can provide and also the training and so forth so that they are across SMAs and managed accounts. One of the things that I think with the AMP SMAs is because we're not charging fees, we've got a little bit of a head start there because perhaps our cost is a little lower in some instances. And so advisors who tend to focus more on cost from a best interest duty, i.e. I don't know whether this one or this one will give me a better outcome. They look kind of similar. They've got a similar SAA and so I expect similar results. If this one's cheaper, then that is something I can actually say is in the best interest because it gives me a greater probability of achieving the outcome given that they're very similar in many ways. And so that, I think, facilitates it, but you know, we don't do that for that purpose. It's just we're trying to provide a lower cost solution and we're not trying to charge management fees.
Yeah, very, very similar philosophy. I think, you know, the three gentlemen sitting in front of you are not fund managers trying to sell a fund with a fee to a planner or an advisor. We've built solutions where, you know, there's the P&L's at the advice front. It's not at the product end. So I think that goes a long way to probably addressing the conflicts issue. You're not actually making a profit from it. So I think that's one thing. The other thing is that, you know, from my perspective anyway, we've been very demand driven. I'm sure Paul is as well, and Justin, in that, you know, you build something because there's a demand for it. So if you've got a demand for a large cap equity SMA, and you've got a research team internally, and you can deliver that, you know, efficiently and you know, costlessly to a client, that's a great outcome. Do those advisors also want to see some other funds and other managers? Absolutely. So we're probably a little bit different because our background is as a stockbroking business. So all of it's off platform. It's all on the ASX. There's 2,500 securities. There's, you know, $20 billion of CHESS holdings or whatever the number is. So they're already dealing in everything. So we don't, you know, have a narrow APL or those sorts of issues. So it's a little bit different with us. But I think as long as the firm is staying, you know, focused on delivering a product where there's a demand for it, and then just finding the cheapest and most cost-effective way to deliver that, then you should be okay.
Any last questions? This is beeping, or blinking or whatever. Any last questions from anyone? Okay, thank you everyone for your
Thanks, Angela.
for your interest today.
Thank you.
Thank you very much. A really interesting series of panel discussions. I think, from my perspective, looking forward for the next 5 years and thinking specifically about how you engage advisors in the process of coming up with the themes that you're going to build into your managed accounts. I know at an individual asset consultant level, that gets done very well, often. But I can tell you at an advice practitioner level, and from a licensee head perspective, there's a dearth of information or tangible sort of programs that people can put their hands on to engage their advisors to do this really, really well. There's an awful lot of promises made by asset consultants, but in terms of actually making it come alive, setting realistic timeframes with advisors about how long it's going to take, and then making it work and what you can realistically expect, there seems to still be an information gap, and I think that's an opportunity for a lot of the folks in this room to really bring that alive. So we'll go on to our next presentation, and that's really how central bank policy and geopolitical stresses will affect investment markets. So we're going big picture. And today, our moderator is Nigel Douglas of Douglas Funds Consulting. Nigel leads Douglas Fund Consulting, which is an independent research firm that undertakes customised fund and client-specific research projects, as well as a range of investment committee work, executive director roles. Nigel has over 30 years of financial markets experience, and I think he's really looking forward to moderating what I think is going to be an excellent session. So I'll ask Nigel to come forward and introduce the team. Thank you, Nigel.
Okay, thanks, Alan. Now, this is a pretty big topic, so we're going to be a bit more structured in this session. I'll set the scene, then Jonathan and Jesse will give short presentations, and then we'll go to Q&A. So we're arguably at a unique point in financial history with unprecedented easy monetary policy combined with massive fiscal stimulus, which fortunately has averted a global recession, which was in turn triggered by the global pandemic, the one in a century global pandemic. Now already, as you know, global equities markets have quickly rebounded and asset bubbles are appearing, such as in Bitcoin, although we can debate that. At the same time, there are momentous geopolitical, social, technological and demographic changes underway. And if that doesn't work out, we've always got Mars, I guess. Okay, despite the noise in social and mainstream media magnifying these changes, a critical focus right now in markets is the short and long-term outlook for inflation. This issue and others will be addressed by our presenters today. Now, on my right, Jonathan Baird is Head of Client Service and Marketing at Western Asset Management. He has more than 12 years of industry experience. Previously, he was a fixed income investment specialist at UBS Asset Management and senior investment analyst at Zenith Investment Partners. Jesse Emmett, on the further right, is a fixed income investment strategist at Mason Stevens, and he has over 11 years finance experience, including 9 years in front office roles. He was at National Australia Bank, Curve Securities, Bloomberg and State Street Bank and Trust, so a diverse group of firms there. Okay, Jonathan will discuss the global macroeconomic and monetary policy outlook, and then Jesse will focus on structural changes, which I mentioned, particularly China, Australia, geopolitics and globalisation trends, as well as looking at important cyclical developments related to the pandemic and optimistically I've said, and its aftermath. So we'll see how we go. Hopefully no one's infected here today. Now, Jonathan, would you like to come to the stage?
Thank you, Nigel, and what an interesting way to lead. I'm glad I've got a little bit of social distancing over here now, following those comments. Look, it's a huge topic, what we're here to cover today, and so I won't even suggest that I'm going to cover all of it or get anywhere close to it, but I'll set the scene a little bit before Jesse will follow me, and then hopefully open up for some interesting dialogue. So in setting the scene, it's probably good to recap a little bit about the magnitude of the drawdown or the freefall that we went through on the back of COVID-19. Now, one way to look at that is through the global output gap. So for those of you who are less familiar with the global output gap, economists attempt to measure historic output or historic growth through GDP, and they also seek to measure the potential output gap in an economy under full employment, so with all workers and resources fully utilised. And the output gap is basically the difference in those measures. So, apologies, can you hear me now? Is that better? Apologies. So the output gap is effectively the difference between where the economy is running and where economists view it to be potentially able to run. So the output gap is when it's below zero. When it's above zero, economists believe that the economy is broadly overheating or running hot, and it's in these types of conditions that they would expect to see inflation start to pick up, and it's much of the debate that we're seeing in markets at this point. So we've seen quite a sharp drawdown and then big recovery. There's a long way to go, but it's fair to say that the V-shaped recovery we've seen so far has been really due to the amount of stimulus that's come through from fiscal policy, so from government spending, as well as that from central banks with cutting interest rates, expansion of... yeah, it's all right, okay. Apologies, IT is not my strong point, so let's get back on the economy. I lost where I left off. So effectively, we've got huge fiscal spending that's been undertaken by governments around the world. As you can see from the top chart, what occurred in 2020 absolutely dwarfs anything that occurred through 2008 and 2009 combined. And we're expecting to see quite a lot more come through, with the US expected to pass through about $1.9 trillion in further stimulus coming through. It is important, however, to highlight that this stimulus we're seeing in this recession is a little bit different to that which we've seen in past recessions, and probably a little bit more short-term in nature, which is really where I think we're getting the divergence of views across the economy when it comes to outlook for inflation and growth. So what do I mean by that? I guess effectively the fiscal policy that we've seen so far is really, if we look at the CARES Act, which this slide here focuses on income in the US, has really been focused on bridging the gap of income from the lockdown or the work from home environment that we're going through at the moment, rather than fiscal policy such as infrastructure spending, which is about creating jobs, increasing demand and confidence over the medium term, which many economists believe would have a higher velocity or a longer term impact on the market. So it is quite different, but we've seen a huge amount pumped through so far, and there's more to come. So there's a lot of debate about it at the minute. What we have seen so far with that which has come through, and we look at the balance sheets of the household sector, specifically here I'm looking at the US, we've seen a lot of this money being used to repay debt, which is quite unusual. We've seen the savings ratio flat to negative over a long period of time, or flat to declining over a long period of time, but we've seen a substantial jump in the saving ratio as household sectors really try to shore their balance sheet up for a really uncertain future. Now, this is a pretty rational decision. If you're uncertain about the future, you don't spend now. And a lot of people are debating whether they're going to start to spend with the next round of stimulus, or whether they'll continue to be quite frugal and keep money in the bank until they work out what's going on with COVID-19. But it is fair to say that this really provides a good platform should we see the vaccine rollout have success and we start to see mobility around the economy again. The consumer is in a pretty good condition to bounce back, or at least in a better condition than they have been in other recessions such as the 2008-2009. Now, some quick comments, I guess, regionally. I focus quite a lot globally and on the US, but a few quick comments regionally. If we look to Europe and the UK, look, it was a basket case coming into the crisis, there's no doubt about that. Inflation and growth have been really hard to come by in that region for an extended period of time. We've got very high levels of unemployment, specifically across Europe. We've got high levels of youth unemployment, which is really challenging for their growth story over the medium to long term. And to be fair, it just doesn't look like changing anytime soon. They've got some structural headwinds there that are pretty significant. Looking to Asia, and more specifically China, and thinking about, I guess, the first economy to enter the crisis or catch the virus, so to speak, and the first economy to come out of it. Now, we take data out of China with a fair dose of scepticism. It is manipulated to some extent. How much that is up for debate. And I've included a range of different forward and backward-looking indicators for the Chinese economy here. But if you look at a broad array of indicators, whether it's these ones or other ones, the picture is fairly similar. It shows China is recovering gradually out of the crisis and probably recovering at a faster pace than most would have thought coming into it. I would highlight, though, that China is a very controlled economy and have dealt with the virus a lot better than most developed nations. Australia is a bit of a different circumstance, but if you look to the US and Europe, China has definitely contained the virus a lot better than most other regions, so it is a little bit different. Now, moving on to, I guess, the long term and trying to assess the impacts of long-term growth and inflation. There's huge headwinds ahead of the global economy that have been in place now for more than a decade, and they're still there going forward regardless of the virus or not. Demographics and debt burdens are key to this. We've got ageing populations around most of the developed world and even some of the emerging world. We've got debt burdens which continue to increase. At this point, it's really with governments that we're seeing the vast increases, but the consumer is still fairly heavily levered if you look across the world. And then other things such as geopolitical tensions continue to drive an introspective view on economies around the world, which is a concern for growth going forward. Now onto, I guess, the topic that a lot of people in markets are really focused in on, and that's inflation. At Western Asset, our CIO, Ken Leach, who's a 40-year veteran of bond markets, suggests that if you're going to pick one driver of the long-term bond yield, which drives so many prices in our market, you'd really look to inflation. Not that we'd only use one, but really inflation is that key driver of the long-term bond yield as we see it. There's been a renewed focus on inflation, I guess, over the last 12 months or so, and that's from the nadir of scepticism around inflation back in March, where we had Australian inflation priced at 0.09% on average over the next 10 years. So relative to an RBA targeting 2 to 3%, it was priced at 0.09%. More recently, it's picked up, which is a similar trend we're seeing around the world across developed and even some emerging economies. And we've seen it sitting around 1.8% as of January this year. Now, this is on the back of an element of rebasing. So that which fell yesterday is the base for today's pricing. Rises in commodity prices. So we've seen prices such as copper, industrial metals and food all go up around the world. And then we've also had a demand for work from home goods, which has been fairly insatiable, especially in the US and Europe. We've seen demand for shipping out of China to the Eurozone quadruple in recent times. So there's quite a bit of demand in there, which is impacting, I guess, the outlook for inflation over the medium term. I guess if we look to the long term, though, it's a little bit more complex. We have those structural headwinds, which I highlighted. We've got support coming through from the fiscal spending, which is very debatable. But I'd say one of the biggest surprises of 2020 was a newfound respect from authorities around Keynesian economic theory. So it's fair to say that most people in power now respect that fiscal spending leads to economic growth. It's just the debate around the magnitude and the duration of that fiscal spending and the impact that has on the economy that's really being, I guess, debated at the moment by key players out there. If I look to former US Treasury Secretary Larry Summers, who's a Democrat, I'll add, he's highlighted a concern that the next round of fiscal spending from the Democrats at $1.9 trillion is about 3 times that of the output gap over the coming years. So he's suggesting that we'll see really high inflation on the back of that with low rates and a high level of fiscal spending, we're going to see inflation break out, which is going to impact financial markets across the globe. And then on the other side, and you probably bundle the Fed in this group, they're a little bit more circumspect about the velocity of this spending and how it impacts over the medium term, with savings ratios and those sort of things I spoke about earlier playing a bigger role. At Western, I'd say we're keeping an open mind to inflation, but we're not of the view that it's about to break higher, or at least demand-driven inflation is not about to break higher immediately, and we're keeping a close eye. I guess one of the key things that we're focused on is credit growth. We think that will be a big driver of inflation going forward, and if we see sustained credit growth from the consumer, we'll probably start to get a little bit more concerned about higher levels of inflation. With that, I'll hand over to Jesse to cover off on his section.
Good morning. Thank you very much for IMAP for having us today. It does speak to the calibre of the guests that we have here and the integrity of IMAP that we are able to have such robust speakers today, so I do appreciate being included in the panels. In terms of the new normal, and we're talking about geopolitics and central banks in this session, we have to talk about and address the structural factors that are having the biggest or the most impact on investment portfolios. Now, quite often we actually don't talk about these. Forward on more? Sorry, thank you very much. We don't talk about these nearly enough because they're kind of in the background. The same way that we became blasé about Brexit or President Trump's presidency after year 2 or 3 is because they're sitting in the background and they were known knowns to us. They kind of fade into the background a little bit. Same thing with other structural factors, such as geopolitics, talking about naval incursions in South China Sea, for example, Australia's access to shipping ports, real wage growth, inflation, which is our topic du jour today. But then otherwise demographic trends, you have the ageing population. Do we have adequate amount of new people joining the labour force? All these factors are of the most paramount importance to us. So talk about borrowing costs and talk about yields. So if we're talking about inflation, and as Jonathan quite rightly asserted, the biggest impact on bond yields is inflation, then we can use Homer and Scylla. So this is actually a chart from 2015. It's from History of Interest Rates, which is a very interesting book if you like economics, where they go into the 5,000-year history, 5 millennia history of interest rates, depicting long-term, short-term interest rates here. And we can say that unequivocally, we are at a point in history we haven't experienced before. We haven't had such low interest rates, to which, if we want to compare to another period, we can't, because it hasn't happened before. So we have to agree to start that we are in a new normal, something we haven't experienced before in history, so we have to come up with new solutions for it. And the reason for this is a conflation of a whole different lot of factors of the last 30 years. We think back about 30 years ago, then we had the emergence of the Chinese middle class through changes in policy from Deng Xiaoping at the time, which over the last 30 years, we've seen more than 250 million Chinese workers enter the global labour supply. We also had post-USSR reintegration of Eastern Europe into the global labour supply. That was another 210 million people. At the same time, we also had increased participation from female workers across the globe, which was also increasing the global labour supply. And all of this together was a profound labour shock, a positive labour supply shock, whereby total available workers increased dramatically over a shortened period of time, which had basically downwards pressure on wages. And we have seen that for decades. So this chart here is just a Bloomberg chart where I've shown wages in blue versus inflation in red. And what's happened is that household income has actually grown less than inflation. People are, in inflation-adjusted terms, worse off on the median compared to where they were 20